So Equifax is reporting that consumer debt has now hit an all-time high of $2.08 trillion, largely driven by the hot housing market. And there's good news and there's bad news associated with this report, and I'm gonna get into that in today's video. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where one lucky subscriber is going to win $5,000 to put towards their RESP, their TFSA, their RRSP, or just to simply pay down their mortgage. It's completely up to the winner. I sincerely hope it's you. All you have to do is subscribe. It's free, it's easy, and it's definitely worth it. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so let's get into it. Let's discuss the report out of Equifax that consumer debt is now at an all-time high of $2.08 trillion. And I'm gonna hit all the highlights of the report. Now, there is good news and there's bad news. I'm gonna tell you all about the amount of debt, why it's higher and those things. And then I'm gonna tell you what the good news is at the end of this video. So let's hop right in and take a look at the report. Here it is. And I'm gonna show it to you actually on the big screen first here. It is this: hot housing market drives overall consumer debt higher ahead of new mortgage stress test. And then with the subheadline being credit card debt is now down to its lowest level in 6 years. So really, really interesting report coming out of Equifax. It has a whole bunch of interesting data. You can go to the Equifax website to find the whole thing, including what the debt levels of certain age ranges are and debt levels in certain cities are. You know, some interesting numbers if you are a credit and math geek like I am. But I'm going to hit the highlights on this one for you and talk about where consumer debt is now and what the good news and the bad news is. So if we go and we take a look at this, the consumer debt level, like I said in the opening, is $2.08 trillion now, which is the highest there has ever been. And this is where it gets really interesting because a lot of this has to do with the fact that new mortgages in Q1 of 2021 are up 41% over what they were in 2020. So that is a really significant amount. And it's very much in line with the increase in housing values, especially in the BC and the Ontario markets. So more people are taking on mortgage debt because interest rates are lower and therefore they're able to purchase bigger mortgages and bigger houses because the interest rates being lower allows their payment to be lower as well. Now, an interesting aside to this, not in the Equifax report, but in a recent RBC report, is payments are actually coming up slightly than they were previously. But the one thing you have to remember is that Canadians have been qualifying at around 5% for their mortgages for the last 4 or 5 years. And they can very much withstand increases to interest rates of 2 to 3% over a 5-year term. Now, whether or not you think interest rates are going to go up that much is a different story. Different people have different opinions on this. People associate high inflation with high interest rates. Not necessarily always the case, but that is something for a video on another day. Now, if we look at the average mortgage limit has gone up to $326,000. So in Calgary, the market that we primarily deal in, this is very much what our average mortgage is. In fact, $326,000 is exactly what our average mortgage was in Calgary in 2020. Now, we obviously do business in BC and Ontario and Saskatchewan. Saskatchewan's mortgages are a little bit smaller. Our Ontario and BC mortgages are obviously significantly bigger. We're typically seeing between $500,000 and $700,000 in those markets. But the average mortgage limit across the country has come up to $326,000. And what's interesting to note is that in smaller markets across the country, those mortgage amounts are coming up as the smaller markets are being dragged up by the BC and the Ontario markets that are so hot right now. Now, BC has had the most significant amount of mortgage growth. Obviously, they're up 59.2%. So their mortgage amounts have essentially gone up by 59.2%. Now, that doesn't necessarily mean the amount borrowed, but the volume of mortgages in BC. So all borrowers combined has gone up by 59.2% since Q1 of last year. And in Ontario, the mortgage growth is 44.3%. Again, these are the two markets that are primarily driving the mortgage growth across the country. Now, this is where it gets interesting because while we're seeing this massive amount of mortgage growth, we're also seeing something else that's interesting. We're seeing credit card debt go down. In fact, it's at the lowest level that's been in 6 years. It's down 9.9 or almost 10%. Now, let's talk about that for a second because why is this happening? Well, like I've been saying about my family, it's the best thing that's ever happened to us from a financial perspective is that myself and my wife aren't running around with a credit card buying dinners and things that we don't need and doing frivolous spending on a regular basis because, quite frankly, we haven't had the opportunity to. We aren't able to go out and eat at restaurants all the time. We aren't able to go and shop all the time because really, do you want to expose yourself to the coronavirus as frequently as you may have, basically been going out and spending money on a regular basis previously? So what we've noticed is that the lockdowns and the inability to go out and do things has actually changed people's financial habits, and they're spending less as a result on things that they don't need. Now, they're spending more, obviously, on things that they do need and that they do want, which is things like larger living spaces, which is why we're seeing the mortgage growth go up. But really interesting that credit card debt has gone down as the coronavirus has essentially forcibly changed the habits of consumers, and therefore caused them to run up less in credit card debt. I think the number one thing, especially for millennials and young people, that prevents people from running up credit card debt is that inability to go out and spend money on food and drinks in restaurants where you see basically a 400 or 500% markup over what it would cost to eat this very same food or make the very same food and drink this very same drinks in your home. Now, this is nothing against the restaurant industry. I love the restaurant industry, but it is one of the biggest contributors to consumer debt, at least in my opinion, and at least in my experience. Now, this is where it gets really interesting because non-mortgage delinquencies, so this is when somebody doesn't make a credit card or a line of credit or a car loan payment, have gone down by 21.8%. So not only are people borrowing less, but they're more capable of making their payments. Now, maybe that's because they don't have the same amount of debt as they had before, but this is a really good sign for the economy when people are having less of a problem making their credit card payments. Now, there was always this fear early on in the pandemic that people weren't going to be able to make their credit card and their mortgage payments. And it turns out that they actually have been able to, and they're doing it more frequently and missing payments less often. Now, when it gets to mortgage delinquencies, this is the interesting number because everyone thought that this number was going to increase as soon as the deferrals and the ability to defer went away. That isn't what happened. Now, mortgage delinquencies are down 19%, which is really, really great news. It means the chances of a housing market crash are lower than what they would be if there was a significant amount of delinquencies. Because one of the things that can lead to a housing market crash is mass delinquencies. And it looks like Canadians, for the most part, are having the ability to make their mortgage payments on a more frequent basis. Except for two markets, and this is where it gets, again, interesting, is Vancouver and Fort McMurray both seem to be struggling with making their mortgage payments. Now, maybe this is something to do with the cost of housing in a place like Vancouver. Maybe in a place like Fort McMurray, it's the inability or the downturn in the oil industry, and maybe there's less incomes up there. But Vancouver and Fort McMurray both have increased delinquency rates. Vancouver 14.6% and Fort McMurray at 38%. So those two economies are economies where you could potentially see some sort of correction or maybe a crash in the housing market because of the fact that it appears that people are having trouble making their payments. Now, again, this isn't delinquency rate. So 14% of people aren't having trouble making their mortgage payments. This is the delinquency rate, which is the percentage of people that haven't been able to make their payments has gone up by 14%. So if there was 10 people out of 100, or let's call it 1 person out of 100 that couldn't make their mortgage payment, there is now 1.14 people who can't make their mortgage payment, if that makes any sense. So, pretty good news across the economy, especially with delinquencies being low on both consumer non-mortgage debt and mortgage debt. I think that is great overall news for the economy. And, at the end of the day, yeah, mortgage debt is going up, but it's going up because interest rates are lower, payments are lower. I really do believe that we are going to be in a low interest rate environment for far longer than what is going to be expected. I just think, and I know that when interest rates get this low, it becomes very hard to increase interest rates. And while they may go up, 0.5 point to 1% over the next 4 or 5 years, they may also very well stay exactly where they are because the Bank of Canada has to undo all of the quantitative easing, all the mortgage buying, all of those things before they can even think about increasing interest rates. And I think as the supply issues with things like lumber and food and steel and commodities. As those things start to work themselves out, we're going to see some of the prices on those things that have gone up substantially in value come down, and a return to somewhat normalcy, at least from a inflation perspective. So that is just, of course, my opinion for what it is worth, but really interesting data out of Equifax. I love it when they do reports like this and we get to see exactly what is happening from a credit perspective in the economy. Obviously, that debt number has grown. The cost to service it has definitely stayed the same or gone down because of the lower interest rates. But what is really, really compelling and really, really good news in my mind is that non-mortgage consumer debt, the credit cards, the lines of credit, the car loans, those things have all gone down in the amount that is being borrowed and also gone down significantly in delinquencies. So if you found this video useful, do me a favor, hit that subscribe button, hit that notification bell, please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers. There's going to be one lucky subscriber when we get there, and we're more than halfway there. I sincerely hope that it's you. All you have to do to enter is click that subscribe button. It's free, it's easy, and like I always say, it's definitely worth it. At least I do my best to make it worth it for you. Cheers.